Hi traders and welcome to today's video. My name is Marco Meyer from AlgoStrats and Trading Educators, and today's topic is keep it simple but not too simple. Talking about trading in general, but especially about trading methods or trading ideas you might have. So what often happens is that you might have an idea for a trading setup, for example, that is relatively simple. Then you look at it, you backtest it and figure out the results aren't so great, and then you go ahead and add stuff to it. And that's usually when you go into the wrong direction, because quite often you're literally already drawing dead because the initial idea you came up with might already not have any edge, and now you're trying to improve something that's completely worthless. So to illustrate that, I came up with a little example here. Probably every one of you has read about these kind of bars at some point. The moment you get a candlestick book in your hand, you're going to read about these. So in the candlestick terminology, these are called hammers, and the opposite of them, like this bar for example here, are called shooting stars. So you have a price bar that has a very long wick, and the open and close are in pretty much in the same range. So the idea of the bar is that you sort of like have a reversal going on during the day, meaning for example here, price traded lower during the day, but then reversed back to the open where it closed. This is considered a bullish pattern, and the opposite of it is considered a bearish pattern. Now these are also called pin bars, and I've mark these automatically here. So if you have Trade Navigator, you can now pause the video and just copy it or send me an email, and I'm going to send it back to you. All it does is it looks okay is the difference between the open and the close a third of the price bar, is the close at the lower range of the bar or at the higher range, and is it not a too small price bar. That's the three things it looks for. And the next one is it at a swing high or low? So an inside bar, for example, wouldn't get recognized. And then you might start out with a simple strategy. Again, that's just what I told you about, same definition as for the highlight bars here. And in this case, I just have the long entry. We would enter at the market and then just exit with a time stop. A couple of days later, quickly looking at the chart here would be an entry, bar closes, we enter market next day at the open, and a couple of days later we get out again. Same thing here, and so on. So let's run a backtest to see if this, even with a very simple test, looks like it could provide an edge. And I'm going to run this without commissions because we just want to have an idea of the pattern, not thinking about slippage and so on. So what you would have to think about if you really build a strategy out of it. But just to do a simple test, it's fine to leave it out and just run it. And what I've done here is that I've run it with an optimization from 0 to 10 regarding the exit day. So what happens if we exit on the very close of the same day we got in? What happens if we exit 1 day later, 2 days later, 3 days later, 5 days later, and so on? Providing that the pattern provides an edge regarding the entry, we should see some difference here versus random, which unfortunately is not the case. So if you look at the profit factor, it's below 1, meaning all of these actually lost money. And if you just pick one, for example, getting out 3 days later, that's what it looks like. And as you can see, from 2000 till 2016, this really just lost money actually. Recovered a bit this year, but that's what we've just seen on the price chart. So you might be tempted to think this works just great if you look at the last 2-3 months. But if you look at it long term, you're going to see that there's no edge, and quite the opposite. The strategy actually loses money. And I won't go into this today, but it's a strategy that's worth to actually flip around. So do the opposite of what you're going to be taught on most trading books, forums, and so on. So in other words, when you see a bullish pin bar, go short, and when you see a bearish pin bar, go long, might be something you can build a strategy out of. So at this point, if you're new to systematic trading or to trading with a method, what you might be tempted to do is to go ahead and think, okay, now let's look at the trades that didn't work out and see why. Or you might say, okay, entering at the market is maybe a stupid idea. Instead, wouldn't it be better to only get in a trade when it actually gets triggered, so when price trades above the price bar on the next day? And then you might go ahead and do just that. So let's modify the entry here and say, okay, instead of going in at the market, we now want to go long at a high plus 1 tick of the current price bar. And we want to go short stop market below. Minus a tick move, which in the E-mini S&P is 0.25. So that's what happens now. So we don't get in at the market anymore, but instead wait if the bar gets triggered or not. And then we just rerun the whole thing. But as you can see, results actually got worse. So this provides worse results than just getting in at the market. And if you look again at, let's use 5 bars. So no edge here in the E-mini S&P. And of course, you might want to look at other markets like the Euro FX, for example, see what it's like there. And here it's slightly better. It's still losing, but it's closer to 0. So here it's random. In the E-mini S&P, it was a negative losing strategy. Again, that might be worth to try to flip it around. But for the Euro, it is exactly what you would expect from a random entry. So it's pretty much coming to 0, mean reverting to 0 here. So you now might get creative here. So we might only want trades where the market is slightly oversold or overbought, so it's more at a swing high or low. So we had an RSI here, and I'm just gonna make it smaller than 50. And for the short side, do the opposite. And if we now look at it, we can see, okay, this one's not triggered anymore. None of these is triggered, but this one is triggered, this one. So it did what we wanted it to do. And as you can see, results are slightly improved, but it's still more towards 1 than anything else. If we now look at the best one around 8 days here, you can see that, yeah, it went pretty well in 2008, 2009, but overall it still looks a lot like random. And the question you have to ask yourself at this point is, what would happen if you would use the same idea without this being a pin bar? So maybe the RSI actually provides more of an edge here than the actual bar pattern. So at this point, you probably still wouldn't be too happy with your pin bar strategy and instead would think, what could I add to it to make it work? What's still missing? So you might now start to add filters like trend filters, looking if there's an uptrend or a downtrend, and you only want to trade in the direction of the trend. Or you might start adding stop losses. So you might say, for example, okay, I want a stop loss here that triggers if the low of the pin bar itself gets violated during the trade. So for example, on this trade here, we would get stopped out right there. Pretty much same results, not a lot of improvement here with a stop loss, as you can see. I could go on with this forever, but the point here is that if a pattern doesn't give you any indication that it has an edge from the very beginning of doing some simple tests, it probably simply doesn't have one. But don't go ahead and complicate it with more trading filters. Trying to filter out the bad trades doesn't make sense, and at that point you're already just over-optimizing and curve fitting. Now I didn't test a random entry here because I would have to go to my other trading platform and that's a lot less visual. But what you basically want to do if you want to test any entry signal is come up first with something that resembles the entry signal in regard to the curve distribution, and then go ahead and compare your actual signal to that randomness and see if it's any better than that. And if it's not, there probably isn't anything to develop any further. So the conclusion is, keep it simple in trading. Keep it simple with your entry signals. It really is true that the simple stuff usually works best. But if you have a simple idea and it doesn't work out and you see there probably isn't an edge there, don't go ahead with that edge and try to refine it, because otherwise you're just going to waste your time. All right, thanks for watching. If you have any questions, you can send me an email to marco@algostrats.com. The free trials for AlgoStrats FX are going to launch soon, now where the Brexit thing hopefully is going to be over in a couple of days, and I hope they don't exit and the markets are like go ahead normal, and then we're hopefully going to launch in early July. You can sign up there to a newsletter. You're going to get informed when the free trial starts, and you're going to be able then to use AlgoStrats FX for free for a couple of weeks. So see you next time and take care.